what exactly do you put in your taxable brokerage or Roth IRA account? If you've been thinking, okay, yeah, I get it. I need to invest. I need to position my money for wealth, but I don't even know where to start. Guess what? In today's video, I'm going to break it down. We are in episode 10 of my investing series. If you are new, go back to episode 1. It should be a link up here that'll direct you to that video where you can watch as I share my journey, the mindset I had, the lessons I learned and unlearned on this journey to help build wealth for myself and my children. So if you are new to me, my name is Ashika Ma'at. I'm a financial coach and the founder of John My Wealth Financial. I help you keep more cash in your pocket so you can position it to wealth and create a life of freedom and ease. What is an ETF versus a mutual fund versus an index fund? How do you figure out the difference between those? I know when you look at it, you're like, okay, girl, I don't even know what I'm looking at. Let me break it down so it's clear for you to know that it's actually pretty simple. So when we talk about a mutual fund managed by a fund manager, this person is essentially saying, I'm going to be looking and analyzing these companies, and I'm going to be picking these companies. I'm going to be putting them into this fund because my goal is to make sure that we can beat the market. They're looking to try to create like that nice little basket of stocks and bonds that's going to beat the market and get you the best return on your money. If there are any losers in that fund, they're kicking them out and bringing in new companies that are going to give you the return you desire. Now, with actively managed funds, if somebody is doing the work of picking those stocks for you, then they got to get paid, right? There are generally fees associated with having someone to manage that fund to make sure that it is profitable and that you are getting a return on it. Next is an exchange traded fund. They are generally lower cost. They're sold on the stock market like a stock. You can go in and purchase a share within a company at any time throughout the hours in which the stock market is open. As I talked about previously with the mutual fund, you can purchase it, but they won't actually execute until the stock market has closed for the day. So that's just something to think about. But with an ETF, it can be bought and sold throughout the day of the stock market. An ETF will contain hundreds of companies within that fund to keep things diversified. You buy one fund, get access to hundreds of companies, similar to a mutual fund, just different in the way that they are operating on the stock market, and also the cost associated with having an ETF versus a mutual fund. Now, when we think about those things, we have mutual funds and we have the ETFs. One of the things that I love is an index fund. An index fund is just tracking a particular market index. You can have index mutual funds as well as index ETFs. An index like the S&P 500 is tracking the largest 500 companies within the US. So if you were to buy an index mutual fund that tracks the S&P 500, you're buying a fund that contains the largest 500 companies. You could also buy an index ETF that tracks the S&P 500. The benefits to having an index mutual fund is there's generally lower fees. These are passively managed investments. It is essentially saying, all right, we're just going to track the largest 500 companies. And the goal is not to beat the market. We're going to be trading alongside it, which should closely match the returns of the S&P 500 index. And so the S&P 500 is just one index. You've heard of the Dow Jones and the NASDAQ. Those are also other indexes. Now, why do you hear mostly the S&P 500 index? It has returned on average, historically, about 10% annual per year. So you'll hear that reference a lot. Yes, there are ups and downs and fluctuations in the market as to be expected, but when you zoom out and look at the S&P 500 index over the last 100 years, you will see that it is growing over time. And the whole purpose with the index fund is to try to match the benchmarks of these index. It is not to beat the market. This is something that I did for myself that I always say with beginners investing is that you want to focus on investing for the long term, understanding the stock market, understanding how it works, but getting into an index mutual fund that tracks the S&P 500 is a good way for you to have more stability in being able to grow your investments over time. So now that you have some that you can potentially invest in and put within your portfolio, I want to break down strategies you can use to start investing your money. One of the things I did on my journey was dollar cost averaging. That was essentially me putting in money within the stock market. Remember in episode 1 when I shared with you I was investing $25 per paycheck? I was putting that consistent amount every single time I was getting paid, regardless of what the stock market was doing, whether the stocks was up, whether it was down. That is what you call dollar cost averaging. You are not worried about the stock price. You are focused on being consistent. Consistency will win the game, especially when it comes to long-term investing. I wasn't able to build up that six-figure portfolio by being inconsistent. I had a strategy, putting $25 in over time. Then I increased it a little bit once I got a raise, kept consistently investing that same amount over time. That is dollar cost averaging. The goal is to build the habit, exercise that muscle of putting aside money into these accounts so it can work for you. If you're just starting to invest and may not have a lot, you can start with fractional shares. You can purchase fractional shares of stocks or ETFs, those exchange. The great thing about this, because this is what I did when I was starting out, especially investing outside my employer account, is putting in small amounts into certain stocks as well as ETFs. The benefit is you're able to get in on the market action, start building up your portfolio, even if you can't afford the full share of a stock. That will help you at least get into the market, build that habit. When I started investing outside of my employer plan, I bought Apple and Google, putting in $25 and splitting that $25 amongst Apple, Google, and Honeywell. I was not able to purchase a full share of these companies. By dollar cost averaging, being consistent with building up your investments, but then using fractional shares to build your portfolio. So there are many different strategies to get you started. So we don't have to be the ones constantly hustling and working. We can take our money and put it into the market so it can work on our behalf and build us more. So drop in the comments and let me know, which one of these are you looking to invest in to build up your portfolio? In my masterclass, I'll be breaking down exactly what I invested in and why I chose to invest in the particular funds that I had to build up my investments. I'm giving you my strategy, my mindset, even my game plan of how I was able to scale to my first 6 figures in investments. If you're ready to build your first 6-figure investment portfolio, click the link in the description and register for my free masterclass, Position for Wealth, Building Your First 100K. And stay tuned to my next video to understand the mindset you need to be a long-term investor to ensure that you are building up your investment portfolio. Thanks for watching, and until my next video, here's to your financial freedom.